Right, sorry. Can everyone hear me now and see the screen as well? Sorry, I think there was some technical issue here. Right, again, sorry. Looks like you not started the webinar. Okay. All right, thanks Justin for pointing this out. Can you hear me now? Is it clear and are you able to see? Okay, perfect. Thanks so much, Justin. Thank you guys. Sorry very much. Apologies for this. Yeah, just a minor technical issue here. Okay, so let's just start from the top. Sorry, I do apologize for this. Yeah, okay, let's just start from the top. Okay. All right, okay. Sorry, apologies. Yeah, okay. So yeah, so I'll just quickly run through the disclaimer as well. Yeah, so risk warning, CFDs are complex instruments and come with high risk of losing money. So please do uh, do your own research and your own due diligence before putting on any trades. And also, likewise, all the content that will be shared in the slides is purely for educational purposes as well. Okay. Okay, my name is Ketan Ramachandra. I'm from Everest Fortune Group, where I'm an investment analyst. So this webinar is brought to you in a special partnership together with IC Markets, and Everest Fortune Group has been the finalist for Best FX and Equity Research for the following years. Okay, so this is just the agenda. Okay, so we'll just skip through this. Okay, so information resources, all right. Okay, so let's go back to Forex Factory. Okay, all right, sorry about that. Okay, now we're back at Forex Factory. Okay, so I've showed you guys. Okay, so when you load Forex Factory, there'll be a window here where you will see the economic calendar. So you can set the time zone according to where you're living at. So for me, I'm just going to set it as GMT time, and then you can select the time period as well. So let's just look at 1st of May to the 5th for this week. And you can filter the data events as well by clicking on the filter icon. So generally I tick all the currencies and event types, and for expected impact, I choose the two most highest impact levels. Okay, so I apply the filter. So you will see all the key data events for this week. So just quickly, last night we have ISM manufacturing PMI data. And the good thing about Forex Factory is when you click on the graph icon, it will show you the history of that particular data point. Right, so this is the ISM manufacturing PMI, which is purchasing managers index, which is now in contraction territory. So this means that the manufacturing sector of the US hasn't been expanding and it's actually been declining. And this has impact on like prices and new orders and future business activity for this sector. Okay, and then if you were to click on the folder icon, it gives you the details. So ISM stands for Institute for Supply Management, and also it gives you the link for the actual source. So if you click on latest release, it will take you to the ISM page, to their homepage, and they'll have the manufacturing services and hospital PMI. So what generally we want to look at is manufacturing and services data. Hospital was something relatively new that came up during the pandemic, and but it's generally not relevant now. So we'll for or if you want to get a good grasp on the state of the US economy, you can click on these charts. So let's just quickly look at view charts of manufacturing PMI. So it gives you the overall state of the manufacturing sector in the US. So any reading above 50 means that the sector is expanding, and conversely, any reading below 50 is contraction for the sector, right? The sector is experiencing contraction. And also you have the headline figure here, manufacturing PMI, followed by various other indices, such as new orders, production, and prices. So similarly, if you were to look at for the services data, you will see the similar summary as well, right? So above 50, The services sector is expanding. Below 50, it's contracting. So there's a slight blip uh, at the end of last year before the services sector rebounded and is continued to expand again, albeit at a slightly lower rate. And then also, of course, as usual, we have the headline services PMI reading, followed by all the various index readings as well. Okay, so this is how you can use Forex Factory to go direct to the original website sources to find out uh, to find and read the reports and get more specific information about that particular data point or data event. So for example, like this week, we have the FOMC statement coming up, right? That is the biggest event this week, 3rd of May. We had another big um, event earlier today as well with the RBA, Reserve Bank of Australia, announcing their cash rate uh, statement, which was released at 4:30 a.m. GMT. So you can see here the previous interest, the cash rate was at 3.6% prior to the announcement, and it was widely forecasted that the RBA would pause as well. But instead, they raised um, interest rates by 25 basis points, bringing it up to 3.85%. So this move surprised markets, and which is why we saw this big surge in Aussie in the Aussie dollar uh, earlier this morning, right? And we also have another event coming up at 11:20 a.m. GMT, where the RBA Governor Philip Lowe will be having his press conference, and this would be a pretty could be a potentially impactful event on the Aussie dollar again, because if his words are construed to be hawkish uh, by the media or by traders, it is very likely that we could see further gains in the Aussie dollar as well. And conversely, if he's sort of neutral or maybe even dovish, you could see some of the gains uh, potentially reverse. Okay, so let's just look at the Federal Reserve and what's going to happen this week. Okay, so as you can see, like I said, we click on the chart icon, you can see the history of how interest rates have been raised in 2016 to 2019, and then they were cut from 2019 to 2020, and finally down to uh, 0.15% after the pandemic lockdowns. And then as central banks around the world were combating inflation, they raise interest rates aggressively. So this rise in interest rates by the Fed has been one of the quickest moves in quite a long time. I think the last time they rose interest rates this fast was during the inflationary period in the 70s. Right, so you can see it is a very sharp move or very sharp rise in interest rates, which caused bond yields to rise and caused the dollar to rise significantly versus its peers as well. Okay, so we'll go into more details on that in a few minutes. But what I would also like to highlight is if you click again on the folder and click on latest release, it takes you to the website for the Federal Reserve and the FOMC. So FOMC basically is Federal Open Market Committee, which is chaired by Jerome Powell. So over here, you will have the list of calendar meetings for 2023 and also for the previous years as well. So not only do you have the schedule for this year, you will also be able to read the statements as well. So at 6 p.m. GMT, the statement will be released together with the announcement of the interest rate increase, and the website would also be updated to give you the full statement as well. All right, so if you would like to read the statement in detail, you can do so at this from this link. Okay, and not only that, you will also have the link for the press conference. I think even if you type YouTube Jerome Powell FOMC press conference, it should give you a link to the press conference where I think you could be able you should be able to watch it live as well, because during the press conference is when uh, Powell will give further insights on the direction of the Fed, whether they will remain hawkish and uh, uh, what are their proposed thoughts and actions for the next meeting, which will be in June. Okay, and also 2 weeks after each, roughly 2 weeks after each FOMC statement is released, the minutes are released as well. Okay, so in the minutes present the detailed discussion and debate between the various FOMC members, and you're able to find more specific insights for particular actions that they may have taken. Okay, so when the minutes are released as well, it can also have an impact on currency markets, and naturally the dollar will be the primary currency to be affected, and you will see the effect on all its peers as well. So these would be the three main things to look out for with regards to FOMC meeting. So we'll have the statement release together with the announcement of the interest rate hike, which today they are almost guaranteed to raise 25 basis points, and the press conference followed by the minutes, which is roughly 2 to 3 weeks later. Okay, with regards to FOMC interest rate hikes, so there's a website that I like to use, which if you type into Google CME Fed Watch tool, right? So here, the first, it will always, well, it is usually the first result in your Google search. So click on CME Fed Watch tool, and it'll take you to the website that calculates the target probabilities for each FOMC meeting. Okay, so this is for today's meeting, which is 3rd of May. So current rate is 475 to 500 basis points. So basically, this is 4.75% to 5%. So when the media or when Jerome Powell and other central bankers talk in terms of basis points, you just have to understand that 100 basis points is 1%. So basically, anytime when anyone is talking about basis points, you you just take that figure and divide it by 100. So if it's 25 basis points, you divide it by 100 and you get 0.25%. Is the session being recorded? Yes, there's a question coming in. Yes, it's a question. Yeah, the session will be recorded, and it should be updated to uploaded uh, to the website in due time. Okay, so what this tool tells us is it calculates the targeted probabilities for each Fed meeting. So if the current rate is 475 to 500 basis points, and if the Fed doesn't raise interest rates, which is very unlikely, as you can see in the probabilities here, whereas the probability for 25 basis point increase is 94%. Right? Okay, this is all priced in usually, right? But what will be important is to use this website for the upcoming meeting, right? So once the press conference is done, the announcement for today's oh no, not today's, for this week's interest rate is all done and dusted, and then on the next day you can probably uh, uh, Google this website and check probably like on a weekly basis to see how the target probabilities are changing for June's meeting, right? So you'll get a very good indication of what the Fed is likely to do as we progress from May's meeting to June's meeting, right? So this is a tool that is pretty useful to uh, to get an indication of how the Fed will react. Okay, there's a question coming in from Justin as well. Okay, if rates uh, are raised, does USD rise or fall? Okay, so it's a very good question, because as we expect, if rates are going to be interest rates are going to be increased, we expect uh, the dollar and US bond yields to rise as well. But as I said, this move could be priced in already. So generally what I like to do is I like to look at the US 10-year bond yield for direction, right? So if you see bond yields falling or rising, particularly the US 10-year, it is quite likely the dollar will follow suit as well, right? So bond yields usually give a good indication of where currency markets are headed. Okay, so this is FOMC, and okay, so now we've covered, and similarly, you can do this for Bank of England, the ECB, RBA, RBNZ, and all the other major central banks as well. So I've just showed you how you can do it, how you can access the various websites for each central bank and the statements and press data that is present. Of course, the data on each uh, website for the respective central banks may be different from the FOMC page here, but the process is the same, right? So you go to Forex Factory, you set your time, you set your filters, and you search for the relevant economic event. Okay, so we've covered how to use Forex Factory. What does the graph icon represent? What does the folder open up to, and where you can eventually end up accessing the actual data from the original source. Okay, so let's just go back to our slides. Okay, so we're going to talk about central banks now, right? So central banks will, depending on uh, the environment that they're currently in, they will either raise interest rates, cut interest rates, or pause interest rates. So as we saw from early 2022, actually inflation was actually rising from uh, the last quarter of 2021, but it was only in 2022 that central banks led by the Fed started raising interest rates aggressively. Okay, so here we have the major central banks, major global central banks. As you can see, the Fed, ECB, Bank of Japan, SNB, and so on and so forth. So what is important to note here is to find out which central banks are raising rates, which ones are maintaining rates, and which one are cutting rates or are keeping rates low. So what we are trying to look for is divergence in monetary policy. Now this is important because when you have divergence in monetary policy between two central banks, this is uh, a scenario where you're likely to have very strong currency moves for this particular pair, right? So for example, in 2022, when inflation was taking off globally, almost all central banks were raising rates aggressively, led by the Fed, except for one. Okay, and the only outlier in this group of central banks was the Bank of Japan, or BOJ. Okay, so the Bank of Japan has kept its interest rates at negative 0.1% for a very long time, right? They have been ultra dovish for many years, and even in an inflationary environment, right? And not a generally, it wasn't even a steady increase in inflation. It was a pretty sharp rise in inflation. The Bank of Japan kept their interest rates at negative 0.1%. So it is important to realize which central banks are cutting rates, raising rates, or keeping rates uh, at very low levels. So this example is showing, or okay, the next slide, couple of slides will show the example of where you have major divergence in monetary policy, and especially in an inflationary period. And you can see the divergence in monetary policy being reflected strongly in the currency pair that are involved. All right. So in this case, the Fed and the BOJ would be USD JPY, right? So this is a weekly chart of USD JPY. from 2021 till October last year, right? So the Federal Reserve started raising interest rates aggressively in March 2022, and you could see USD JPY take off pretty sharply, right? And all the way till October as well. So when you have divergence in monetary policy, like in this example, you will see probably the biggest move in the currency pair, right? Okay, so before I go on to the next part of this, let's just look at the chart. Okay, so let's just go to trading view. Let's go to the dollar yen. Okay, so now I'm on a daily chart here. So as you can see, March onwards was when the Fed started raising rates aggressively, and the dollar yen went from 115 to as high as 152. Of course, in any move to the upside or downside, the price doesn't go up in a straight line. You can always expect pullbacks to occur, and this is where you can use technical analysis on a daily chart. I like to use start off with a daily to do technical analysis on a daily chart so that you're able to appreciate and understand the longer term view of a particular commodity or currency pair. So in this case, you can see that there's a strong uh, uh, bull market for dollar yen. And then when you do technical analysis on a daily chart, and then you zoom in on the H4 and H1 time frames, you're able to identify potential support and resistance levels. And knowing that you have this divergence in monetary policy between the Fed and the BOJ, you are able to identify uh, potential entry points to go long again as well. So let's just do a quick Fibonacci on this. So for example, this is a daily chart. So let's say price has run up here, and okay, so you do all fibs, and as you can see, let's just leave 23 and 38%. Is it 20? Okay, let me just do 23 and then 38%. Okay, so when we do Fibonacci on a daily time chart, you're able to see long-term trends and also identify potential support and resistance levels, right? So one of the first support levels that would be identified would be around the 23.6% Fibonacci retracement, right? Then that was at about 127.25. Yeah, 127.25. So for the dollar yen. So once you draw the Fibonacci, once you see a big leg move up, you see the peak and you see price consolidating, moving sideways and suddenly pulling back, you would like to see where the first support would be. So by running a Fibonacci retracement, and remember Fibonacci retracement always runs from the left to the right. So if it's an upward leg of the move, right, you do it from left, bottom left to top right. And if you're running Fibonacci on the down leg, you do it from top left to bottom right. So for example, in this case, you could see price did pull back uh, to the 23.6% Fibonacci retracement, consolidated around this level for a few days. And knowing the fact that the Fed was continuing to raise interest rates aggressively while um, the BOJ was keeping their rates at negative 0.1%, the divergence in monetary policy was still ongoing, and you would have highlighted this area as a potential buy entry again. And then you would have gone long around this level, and your stop loss, you would have set it at okay, also again depending on your risk management process and your risk tolerance levels in terms of percentage and dollar terms. So you could use the 38.2% retracement level as a potential, or to identify as a potential stop loss level. And generally, I like to have a 1 to 3 risk reward ratio in place. So with that, you can see if in this scenario, if you had kept your stop loss here at 38.2% and you had uh, gone long at about 127.25 or 30, you would have had a very good minimum 3 to 1 risk reward ratio as well. And as the price is moving up, it has bounced off our support level and price is moving up. It is also very important to trail your stop loss level as well. So this trailing of the stop loss can be done manually, or it can be done as part of a automated order as well. So you can see where technical analysis combined with the fundamental picture of monetary policy divergence is able to um, help us identify the longer term trends, find support at various levels, and then to go long again, for example, as we expect the divergence to continue, right? Okay, then for the second part is, okay, so for the first part, we look out for is monetary policy divergence, right? So this is why I use the dollar yen as an example to highlight this differences between policy actions by the central banks. So once you identify, uh, okay, not identify, but you look through the list of the major central banks, we don't need to go into full details of what they're actually doing for each central bank, but you just need to know whether are they raising rates aggressively, are they maintaining rates, are they cutting rates, or are they keeping rates low for extended period of time. So once you know what each central bank is doing at the high level, then you are able to identify potential monetary policy divergences. And once you do that, then you find that pair, and then you do perform technical analysis on a daily chart to identify longer term trends, and then also use your favorite indicators, right, or your preferred indicators rather, and identify potential support and resistance levels, right? So this is the first part of why we look at major central banks and what they're doing. And the second thing is also related to the dollar yen again, because towards the end of 2022, there was a big uh, change in the direction of the dollar yen, right? So there's a big intervention uh, carried out by the Bank of Japan. So what they did was, because the currency was getting devalued very strongly, so as dollar yen goes up, the value of the yen uh, drops significantly, and this is not good for Japan in terms of its imports, right? So when your home country loses its value versus, for example, the US dollar, and when generally most goods around the world are traded and priced in the US dollar, suddenly your imports become very expensive. And we were already in a highly inflationary period. So having a very weak yen was not helpful for Japan's imports, right? They were getting too costly, right? Double whammy of high inflation plus a weakening yen. So, and if you go back to the chart, right? Let's just zoom out to a monthly chart for the dollar yen. So as you can see, this level of 150 was last hit in 1990s, right? So the late 1980s and early 1990s was when the yen hit 150, the level of 150. So this was a 30-year period high, right? So this was a very significant move in the dollar yen, which was caused primarily by the divergence in monetary policy. And because the dollar yen hit such high historical levels, the Bank of Japan had to intervene in the open market. So what does central bank intervention usually means. Okay, so usually they will end up buying the currency if it's if it's devalued too much, and they will sell the currency if it's appreciated too much. So in this case, the yen had um, devalued very significantly, and the Bank of Japan intervened in the open market by selling their reserves, right? So Japan, along with China, has one of the largest foreign reserves in terms of US treasuries and the US dollar. So they were selling their foreign reserves and buying back the yen in the open market. So when they did that, that put that caused the dollar yen to peak and pull back very significantly. So this news was reported as well. You don't need to subscribe to any Bloomberg or CNBC subscription to receive this type of news, because even your local papers would have covered this as well. So like your local media outlets in the business sections would have covered this as well. So if you just type BOJ intervention, so this occurred around October, right? So is this? It happened, yeah, so around October. So towards the end of October, various news outlets would have picked this up, and you don't need to have a special subscription or paid service to get access to such data, right? So even your local news media outlet would have picked up on this piece of information, and this is when you can should signal to you that okay, something big is happening in the currency markets, and especially Bank of Japan. Even though they're keeping interest rates at negative 0.1%, they are now actually selling their foreign reserves and using the proceeds of that foreign reserves to buy the yen in the open market, right? Oh, sorry, so which is here. So this happened in the third week of October, and this was where you could see dollar yen peak at about 152. It pulled back pretty sharply, consolidated between 149 and about 145 for a few weeks before it finally uh, started dropping significantly. So upon hearing the news of the intervention and understanding the mechanics of the intervention, like I said, we don't need to go into the details, but of what the central bank is actually doing, but the reports and the headlines would have given us enough information to identify that to inform us that the BOJ is now selling their foreign reserves and buying back the yen in the open market. So this should have signaled up to us that okay, this is a potential top in the dollar yen, and we should actually be looking to short the dollar yen moving forward. And this was the period, like I mentioned, I like to use the US 10-year bond yield as a guide. And this was also the period where bond yields started to peak as well, and bond yields started to fall as inflation in the US started, at least on an annualized basis, had peaked uh, in the middle or in the third quarter of 2022, and inflation was falling on an annualized basis. The US 10-year bond yield was also falling, uh, pulling back. Plus, you had the Bank of Japan intervening in the open market. So these three fundamental data points should have given us enough information to deduce that there's a very potential peak that has occurred in the dollar yen, and moving forward, we should expect the dollar yen to weaken. Right. So this is how um, we use fundamental analysis, technical analysis, and divergence in monetary policy actions to identify moves to the upside, and then paying attention to how inflation is moving, because the move to the upside was caused by rising inflation, which caused central banks to raise interest rates. And when we see inflation peaking on an annualized basis and starting to uh, head lower, together with US 10-year bond yields dropping, and we also see the added uh, factor of the BOJ intervention, this should be signaling to us that dollar yen is very likely to start pulling back. which is what has happened from the third quarter of last year all the way till early Jan. So this is how we can, it is important to take note of central bank actions in terms of monetary policy divergence and potential interventions. Okay, so if we go back, okay, so let's just quickly go back to the slides. Okay, so we'll just now touch on the dollar index. Okay, so the dollar index is DXY, right? Okay, so prior to this, we had the Bretton Woods Agreement in place, and then President Nixon dissolved it in 1973, and US dollar index was created, right, with the base set at 100. So if you're wondering why the dollar index trades between 80 to 90 to 100 to 120, it is because when the agreement was dissolved and a basket of currencies were created to value the US dollar like a trade weighted basket, this value was set at 100. Okay, and the basket is made up of the following currencies. So we have the euro, Japanese yen, pound sterling, Canadian dollar, Swedish krona, and Swiss franc. Okay, so the euro, as you can see, makes up a significant portion of this basket. So whenever we see the euro dollar rising strongly, it means that the dollar index is very likely to be falling, right? Because as you know, euro dollar is with the dollar as the denominator. If euro is rising, the denominator is falling, so hence DXY is falling as well. So it is important to note that it is the euro that is usually driving or the relationship between euro and the US dollar, which is driving DXY, which is the trade weighted basket uh, of currencies, right? So if you see there's very strong demand for euro versus the dollar, obviously euro dollar will rise up, and this price action is reflected in the DXY. So conversely, when euro is being sold aggressively and dollar is being bought aggressively, the DXY will rise. So it's important to note that it is usually okay, it's not usually, it is the underlying currencies that drive the direction of DXY, right? So once you know how these main currencies are performing relative to the dollar, it will tell us exactly what DXY is doing. So if you have the euro, yen, and pound very strong on a particular day, then naturally, of course, you'll expect DXY to be heading lower. So this is why it is important to understand uh, um, what DXY is composed of, and what are the relative strengths of the underlying currencies, right? Okay. Okay, there's a statement um, from Janet as well. I'll just check Forex Factory calendar to see which currencies expect a larger move. Yes, that's right. By identifying key economic data events such as central bank statements, monetary policy statements, as well as looking at inflation data, employment data, you're able to understand how the results of such economic events drive currency markets. Okay, so this is DXY. Okay, okay, so key economic data, right? Okay, so generally I like to look at GDP, right? PMIs. For the US, I like to look at the ISM PMIs, which is what we covered earlier, the PMI data from the Institute for Supply Management, look at employment report, and obviously what has been hogging the headlines for the last 2 years is inflation. And I also like to look at government bond yields and yield differentials as well. So like I said, when you see bond yields moving up aggressively for the US, especially for the US 10-year, then it's very likely the dollar, uh, the US dollar will follow suit, and hence DXY should rise as well. Okay, so let's look a little bit into the various data points as well. Okay, before that, US inflation. Okay, so how, like I mentioned earlier, like ISM prices. So let me just go back to Forex Factory, right? Okay, so I'll click on the folder here for ISM Manufacturing PMI, go to latest release, and that takes me to this page here. So when you look at view charts, okay, so there's the headline figure and you have all the other sub indices as well. And prices here refers to, of course, inflation in the manufacturing sector. And conversely, uh, when you look at the report for the services sector, you will have the same sub indices as well. So if I just scroll down to prices, so you can see for the manufacturing sector, prices were elevated throughout 2021 and the first half of 2022 as well. And once the Fed started raising interest rates aggressively, it had an impact on demand. Demand started falling off, particularly for the manufacturing sector. So this was reflected in the prices index for this report. And prices started falling, falling, falling. And as we mentioned earlier, a reading below 50 means contraction. So this was when prices were really pulling back in the manufacturing sector. So similarly, if you were to look at the charts for the services sector, so again, throughout 2021 to almost the first half of 2022, the prices index was elevated and started pulling back steadily in the second half of 2022 and is pulled back even further in 2023. Although the reading is still above 50, which means that prices are expanding, but they are expanding at a much lower rate. So this has an impact on overall inflation as well. So if you see prices in the manufacturing sector and in the services sector pulling back, naturally this will feed into the rest of the economy as well, and it will feed into consumer price index as well. So which is why when we go back to this chart, go back to our slides, right? Okay, so this is where I get uh, the data for the red line, right? So the red line is giving me the ISM prices average. So what I've done in this case is I've taken the price readings for each month for the manufacturing and services sector and done a simple average. I just add the two figures for each particular month divided by 2, and I've plotted it against CPI price, right? Okay, or CPI or the CPI reading, right? So this is the annualized consumer price index from 2003 all the way to the present time. So remember, CPI data, ISM data are released on a monthly basis. It doesn't, unfortunately, we don't get any official data from these agencies on any higher frequency point, but yeah, on a monthly basis, we are able to see the relationship between ISM prices, the average of ISM prices versus CPI. So what this chart is telling us is ISM prices, which is in red, generally tends to lead uh, the CPI price or CPI level, which is in blue. So the relationship is relatively tight. Oops, sorry, is relatively tight. So in most cases, when you see ISM prices or the average moving higher, you can expect CPI prices to follow suit. And conversely, when ISM prices are falling, you can expect CPI prices to fall as well. So this relationship has held uh, pretty closely throughout the last 20 years, and it was very evident in uh, the second half of 2020 and 2021. So even though central banks only started raising rates in 2022, with the Fed starting in March of 2022, actually ISM prices were rising pretty sharply way beforehand and had a lead of about 2 to 3 months. Okay, so it was only 2 to 3 months later where CPI readings started to rise sharply as well. And then ISM prices started to consolidate and peak in middle of 2022 and started falling sharply, led primarily by the manufacturing sector, which then eventually fed into consumer price index readings, and that peaked as well at 9% and started falling. Okay, just to highlight that the left axis shows us the annualized change in CPI reading, which is in percentage, and the right hand axis, is showing the prices average, right? Index, which is an index level which goes anything between 40 to 85, right? So ISM prices had actually predicted the peak in inflation followed by its rapid decline as well. So together, once you see inflation falling, you see bond yields falling, and also you see uh, an intervention uh, taking place in the open market, with the example of the BOJ, where they were selling their foreign treasuries to buy back the yen at the open market. You could see that this was the point where the US dollar started had peaked and started pulling back significantly versus the rest of its peers. So this is how we can use fundamental data and news events, and then pitch it all together on a longer time frame, such as the daily chart, to identify the uptrends and downtrends, and also potential turning points, right? Either as a topping process or as a bottoming process as well in the price action for a particular currency pair. Okay, let's see. Okay, we have about, I think, 5 minutes left, I think. Okay, right. Okay, so this is talking about US inflation and key economic data. Okay, so for inflation as well, right? Okay, so let's just go back to forex. Okay, and also maybe I'll just let me see if I can add, oh, what's this? So I can add this. Okay, so this is the dollar yen on the upper half of the chart, and on the bottom chart I'm going to put the US 10-year yield. So that's very simple. Just type US 10Y and you will get the bond yield for the United States 10-year government bond yields. Okay, so let's just make it about the same. Okay, are my crosshairs all aligned? Okay, yes. Okay, so my crosshairs are aligned as well. So let's just move back a little bit. So as you can see, okay, so this is a daily chart. So we saw dollar yen rising due to the monetary policy divergence between the Fed and BOJ. You saw US 10-year bond yields rising sharply as well. And as the intervention took place, bond yields sort of consolidated and peaked. Actually, the 10-year peaked at about 4.3%, started pulling back sharply, consolidated for a while, retraced a little bit, and started pulling back sharply. And this was a significant turning point due to several factors, one of which was uh, intervention by the BOJ, the peak in inflation, right, on an annualized basis. You saw CPI inflation peak and falling down. So together with this uh, fundamental data points, we are able to identify a potential peak in the dollar yen and also in the peak in the dollar index as well. So if I were to change the upper chart to DXY, right, which is the dollar index, similarly, you are able to see the move as well, right? The dollar index peaked at about 115 in September of last year, pulled back sharply down to 110, and then you could say it consolidated between about 113 and 110 for a few weeks before pulling back sharply again. And these moves are also reflected in the level of the bond yields as well. So this is how I like to use fundamental analysis, looking out for key economic events, key uh, actions by central banks, be it in terms of monetary policy, in terms of interventions, and then following the bond yields, or the direction of the US 10-year bond yield, and then performing technical analysis on your preferred currency pair or your currency pair of interest, right? and then identifying potential turning points in currency markets, and also trying to see when the turn has happened. So we went from a bear market in the euro US, of course, as the dollar is rising, strengthening significantly, as the bond yield is rising. You expect the euro dollar to fall in value. And once bond yields peaked and started falling, plus the whole bunch of other factors we discussed earlier, you saw euro USD bottom and started to retrace uh, a lot of the losses and make uh, a relatively significant bounce up. Okay. Okay, there's a question, yes, by Desiree as well on the US debt ceiling and how it affects bonds and USD. Yeah, this is also okay. This is a good question, and it is. I think this time is pretty difficult to anticipate how bonds and dollar will react going into it. Usually, uh, at every debt ceiling deadline, there's a lot of political debate that goes on between the House and the Senate, Republicans and Democrats, and usually it always gets resolved. But I think in general, I think we can expect higher volatility as the deadline approaches, which is now, I think, somewhere in June, I believe. So it's not that far away, between 4 to 6 weeks away. So I think as we approach closer to the deadline with no obvious resolution in place, then I think we can expect higher volatility in this period. Now, whether this means that the dollar gets bid because of safe haven fears, or because the dollar gets sold off strongly because everyone thinks that markets and investors think that the US is actually going to default, right? So I think it's quite difficult to call this one. So it could really go both ways. Yeah. So I think it's important to note when the debt ceiling deadline is occurring, which right now, if I'm not mistaken, is at some point in June. So as that deadline approaches, I think we can expect higher volatility, and I think use the US 10-year bond yields as a direction for what the US dollar uh, could do, right? Because if the US really is about to default, that means no one wants to hold dollars and they're going to sell it off aggressively. Whereas if they think that, oh, okay, this will get resolved eventually, so no one's investors and traders are not going to sell the dollar off aggressively. Okay, right. Okay. Okay, yes, I've come to the end of today's webinar. So this, just remember, guys, this is part one. We'll be covering part two in a week's time. Okay, there's also a question from Hadika about euro yen and Swiss yen. Okay, so I'm sorry, we don't have much time to discuss on this, and I'll try and cover this um, for next week's session. Yeah, I'll try and cover this for next week's session. And because also I primarily look at the majors as well, so I look at euro dollar, uh, Aussie dollar, dollar yen. So euro yen and Swiss yen is something that I do not uh, trade or look at actively. So, but I'll try and see if I can come up with something for this for next week's session. Right? Okay, guys. I think yeah. Thank you for your time. But before you go, don't sign off just yet. I will be running a poll. Yeah. Okay. So this is okay. So it's just a simple poll on how do you rate this webinar. So I'm just going to launch it now. I think okay. The poll is open, guys. So please rate the rate this webinar accordingly, and any constructive feedback is much appreciated because we're always trying to deliver the best content and information to you. So any feedback, constructive feedback would be really helpful for us as well. Right, and let me see if there's anything else while the poll is running. Just let me take a quick look. Okay, and also please take note, once the webinar ends, a survey will be sent out as well. So once again, yeah, please help to give your feedback as well. We really appreciate it because Like I said, very good constructive feedback is something that will help us to deliver good content for you guys, right? Okay. Right. Okay. I'll just keep the poll running, open just for a few more minutes, right? And yeah, so next week's webinar part 2 will be covered next week as well, same time, and it'll be on the 9th of May. Okay, and while we are waiting, right? Okay, thank you everyone, yeah, for tuning in. I see messages coming in. Thank you very much. Really appreciate it. And yeah, and we look forward to your feedback as well. All right, I think, yep, okay, I think we've got most of the votes coming in. Okay, so I can, while the poll is still running, yeah, okay, so just for today's 2nd of May, right? Okay, so let me just refresh this. Okay. Okay, so yeah, so okay, if you're trading the Aussie dollar today, so please take note that 11:20 a.m. GMT, Governor Philip Lowe will be speaking. So this could have an impact on further impact on the dollar, Aussie dollar as well, if he's hawkish. You have JOLTS job openings data coming up. This is a data point for the employment market or the labor market for the US. And so this is at 2 p.m. GMT. So if this number is higher than forecast, okay, so previous reading was 9.93 million. Current opening is current forecast is 9.74. So if you get a reading that's higher than the forecast, it is quite likely you should see the US dollar gaining strength. You should see the 10-year bond yield gaining strength as well. So this means DXY should be rising, and of course the other its counterparts should be falling as well. So this is something to take note for today as well, because the US dollar has started the week on a pretty strong footing. So this would be a key data event that's coming up at 2 p.m. GMT. Right. Okay. Right. Okay. I think we are done for today. Thank you very much, guys. Hope you've enjoyed this. Ladies and gentlemen, hope you have enjoyed this, and we'll see you next week for part 2. All right. Thank you, guys. Take care.